If you're looking to capture the full power of the global stock market without any safety net slowing you down, VEQT is likely the ticker you're currently looking at. It's truly a crown jewel of Vanguard Canada's asset allocation lineup, a 100% all-equity portfolio that holds over 13,000 stocks in a single fund. But as we move into this year, the battle for your TFSA and RRSP has never been more intense. With fees being slashed across industry and rivals like XEQT gaining ground, many investors are asking, is VEQT a good investment for the long haul, or has it been eclipsed by the competition? Today we're going to look under the hood at the latest VEQT holdings, break down the brand new VEQT MER, and finally settle the VEQT versus XEQT debate so you can decide if this is the only fund you ever need to buy. So let's get right into it. Let's start with the basics. What is VEQT? Known officially as the Vanguard All-Equity ETF Portfolio, this is what one may call fund of funds. When you buy one share of VEQT, you aren't just buying one stock. You're actually buying 4 different Vanguard ETFs that cover the entire world. It includes, obviously, the US market, the Canadian market, as well as the developed international markets, like Europe and Japan, for example, and the fast-growing emerging markets like China and India. The key thing to remember about the VEQT stock price is that it represents 100% stocks. Unlike VGRO or VBEL, there are 0 bonds here to cushion the market crash. This makes VEQT a pure growth play, designed for investors with a high risk tolerance and a long time horizon. People who are okay with seeing their account balance swing pretty wildly in exchange for the highest possible long-term returns. In short, it's truly the ultimate set it and forget it tool for someone who wants to own the world's economy in one click. The entire globe. But let's look at the VEQT's biggest competitor, XEQT. In the world of Canadian personal finance, the VEQT and XEQT rivalry is the equivalent of Coke and Pepsi. For years, XEQT had a slight lead because it was a little bit cheaper, but a few months ago, Vanguard fought back. The VEQT MER was recently slashed from 0.22% down to 0.17%, making it one of the most cost-effective portfolios on the planet. For every $10,000 you invest, you're now paying just $17 a year in management fees. So how do you choose? Look, it really comes down to home bias. VEQT holdings include around about 30% allocation to Canada, while XEQT usually sits lower at around 25%. So it's very simple. If you believe Canadian TSX, Toronto Stock Exchange, with its heavy focus on banks and energy, is a safe harbor, you probably want to buy VEQT. If you'd rather have an extra 5% spread out across the US and international markets, XEQT might be the ETF for you. It's worth noting that both funds most of the time post nearly identical returns last year, for example. So at this level, I think either works out depending on your personal philosophy and relationship with the provider. The question I get constantly is, does VEQT pay dividends? And the answer is yes. But the schedule is slightly different from what you might expect. Most all-in-one ETFs pay you every 3 months, but VEQT pays dividends annually. So this means you'll see one large distribution hit in your account in early January, rather than smaller chunks throughout the year. The VEQT dividend is often around 1.3, 1.4%, and while that might seem pretty low compared to a high-yield bank stock, for example, you have to remember that VEQT's goal is capital appreciation and not income. The fund collects dividends from 13,000 companies and interest across the globe. Then it bundles that into a single yearly payment. If you're using a broker like Questrade or Wealthsimple, make sure to check your VEQT dividend schedule and turn on your DRIP so that yearly payout is immediately reinvested to buy you more shares. If you don't know what DRIP is, it's the dividend reinvestment plan. Now let's look at a couple different risk hedging options. Many people ask about VEQT versus VFE, for example. VFE tracks the S&P 500, the 500 biggest companies in the US. And while S&P 500 has been on a tear recently, really, it's still just one country. You're not necessarily diversified. If the US tech sector takes a hit, VFE goes down with it. VEQT, on the other hand, gives you a little bit more of an insurance of global diversification. If the US stumbles, but let's say Canada or emerging markets thrive, VEQT has your back. On the other side, you have VGRO. The difference here is simple. Bonds. VGRO is 80% stocks and 20% bonds. In a massive market downturn, VGRO will generally fall a little bit less than VEQT. And if you're the type of investor who checks their app every single day and gets a knot in their stomach when they see red, honestly, you might be better off with the more balanced approach of VGRO. But if you can ignore the noise and stay invested for 10, 15, 20 years, the 100% equity portfolio of VEQT has historically been the path to building more wealth. So, is VEQT the smartest investment you can make? Well, it's tricky. If you value simplicity, low fees, and maximum growth, it's hard to beat. You're essentially hiring Vanguard to be your personal portfolio manager for a small fraction of a percent. Here's what I would say. I would say choose VEQT if you want 100% stock portfolio, if you have a 10+ year time horizon, and if you prefer Vanguard's 30% Canadian weighing and their newly lowered fees. I would say choose XEQT if you want slightly less Canadian exposure and you prefer the iShares ecosystem. And lastly, I would say choose VGRO if you want the growth of VEQT but need a little bit of cushion, need a 20% bond cushion to help you sleep at night during a recession or a downturn. And trust me, sometimes it means the world. Anyways, let's wrap this thing up. As always, this video is for educational purposes only. I am not a financial advisor, just a guy sharing my own research and opinions. So please do your own homework, do your own research before moving your money around. Please hit that like button and subscribe to the channel. It honestly helps the YouTube algorithm realize that these videos are at least somewhat watchable, and I'm actually bringing a minuscule amount of value to the personal finance community. So, and that's all I want. Anyways, guys, thank you so much for the support, and I'll see you in the next one. Take care.